Hello everybody. Thank you for joining this webinar. Today we are going to focus on business valuations and using the Invest for Excel Enterprise Edition. We have 1 hour time for the webinar and we have a lot to go through. So I will begin immediately. Just a few words. So Data Partner is a Finnish software company, 33 years old. We are a leading provider of software for investment appraisals, financial modeling, and valuations. We have international local partners that locally train and consult and sell and support. All in all, we have some 1,750 customers in 56 countries. And the main product is this Invest for Excel-based solution for investment appraisal, financial modeling, and valuation. And we also offer services around it. We have customers from most industries. The biggest segments being electricity and heating, engineering and consulting, pulp and paper products, real estate, chemicals, food and beverage, transport and logistics, metals and metal products, oil and gas, and so on. And you will be receiving this presentation, this PowerPoint, by email afterwards, and you will also receive a link to this recording of this webinar. So in case you want to go back and check something, to have a repetition, or if you have to leave early, you can always come back and continue. Topic today, business valuations. So we will do a practical demonstration on how a company valuation can be done using Invest for Excel Enterprise Edition. We do this in 2 phases. First, we do the valuation of a company, and then we look at the effects of the acquisition on the buying part, on the group. And in the valuation, we will see how to include financial accounts for the past years, historical income statements and balance sheets, how to model the forecast to make projection forward-looking financial statements, and how to set the terminal value at the end to perpetuity. And then we will make the valuation based on free cash flow. We will look at KPIs and the DuPont model and maybe make some sensitivity analysis, but then we go forward and look at phase 2, the effects of the acquisition. So we will put the price, make a goodwill calculation, see at the marginal effects on group level of the acquisition, look at the acquisition as an investment, make an investment appraisal, do sensitivity analysis, and then even consolidate the new subsidiary into the group forward-looking financial statements. So here comes the work sequence for valuation and acquisition. Before we go and do it, you can take a look through it. So again, phase 1 valuation. So you start, of course, creating a new file and defining periods, how you will handle taxes, and set discount rates. Then we will go forward and put the past income statements, inputting them, and then go forward to balance sheet and input at least opening balance, but it would be good also to have some years backwards. And we also need to set depreciation plan for ingoing book values. Then we go forward and make the forecast to forward-looking financial statements, and we can start with CAPEX. So we enter normal annual investments, to maintain the business and consider if there's some new investments planned. Then we make the income statement projection for coming years. How do we think that the business will develop over time? And we model the working capital quite easily, look at cash flow statement, continue the balance sheet, which is maintained automatically by the program, just to check that it looks okay. Then we can add some key financials to check the health of the business and to get some numbers to compare to other transactions or similar companies. And then finally we will go to the profitability analysis on result sheet and make the valuation. So first of all, we need to define the present value of residual. So we use the perpetuity or extrapolation function to calculate the terminal value. Then we adjust the value for debt, net debt, maybe make some manual corrections. And then we arrive at the free cash flow based equity value of the company. And we'll also take a look at the equity value divided with EBITDA as a indicator. And then we make sensitivity analysis to see how they impact the value of the company. But that was phase one. Phase two is then that we will enter a price for the shares, price paid for the shares, and assuming the 100% price, although we buy any smaller amount. Then we can make a goodwill calculation, and for the goodwill we either depreciate, or if we use international accounting standard, we just test the value. But in that case, we need to allocate the overvalue as much as possible to different assets. We will also model how the company acquisition is financed. And then we are ready to start to look at the effects of the acquisition. We will see the marginal effects on income statement on group level. How will the income statement change? How will the profitability change? We can see the marginal effects of acquisition on group balance sheet, how it changes. And then we can make an investment appraisal of the company acquisition, like any investment, to look at normal investment ratios like net present value or IRR or payback or many others, and continue and make sensitivity analysis. Okay, that's the process, and now we go into these steps, step by step, starting with phase one and valuations. First we do basic assumptions, then input of final accounts, then forward-looking financial statements, and then finally the valuation. So first, of course, we create a new file of type acquisition, and we define the periods, the term of the calculation. It's usually like 5 years or 10 years plus perpetuity. Of course, we also define a required rate of return. Usually WACC is used for discounting. Then we have the corporate income tax and some options related to that, whether we choose to have the default method that Invest for Excel calculates the taxes automatically from profit, or if we want to be able to adjust it ourselves, then we can select income tax manually. Then we can take into account if there are like some tax history with maybe losses brought forward or something like that, then we can adjust for that. Okay, now I will also switch to the program. Invest for Excel, it's open here in the background. And I open an existing calculation which has already input of values, so I don't have the time within this 1 hour to input everything. So we have a slightly easier way to do it like this. Okay. So yeah, 10 years forecast on annual basis plus residual value perpetuity / extrapolation. We have included 4 historical periods: 2020, 2019, 2017, 2016. So that's the periods, and numbers are in 1,000 euros, and here's discount rate set of 7%. I could actually push the button and go into the WACC button, and okay, it's not filled. Let's put something. Let's say we can now consider the cost of capital of the buying part. So let's say they pay 5% interest on debt taken for the acquisition, and the buying part's company tax rate is 20%. And let's assume we put 70% debt out of 100 total. That leaves 30% equity. And if the required rate of return for equity is 15%, then actually we land at the weighted average cost of capital of 7.3%. And I can just press use this calculate it back to as a discount rate. And by the way, now it would then discount from the end of the year. I could also choose here to discount for mid-year. Why not do it actually? So then it's a little bit more accurate, because everything that happens during the year will then be put in the middle, which is an average. And it now shows that I chose mid-year discounting. The corporate tax was 20. We didn't replace that one because this one was entered. And the tax options, yeah. So now it calculates automatically. So the profit multiplied with the income tax percentage, but I can also choose to have to model it manually if there are some special things to consider. Then it will remove the formulas and remove protection, and you can create your own Excel formulas to put the taxes correct way. And also you can have different tax percentage for mother company and the company to be acquired if it's cross-border acquisition. Okay, that was the basic values. Let's go back to the PowerPoint, and next page is then inputting of past income statements. So now we will take a look at the income statement, and we have four years for historical numbers, and of course the more years you have, the more you can see a longer trend for the business. It's up to 6 possible invest for Excel. And of course, if you take like one annual report or I mean closing of books, the numbers, then you typically would use the same main headings when you enter the numbers, the outcome. Otherwise, you can use subrows to freely model any way you like the business, and it can be helpful also to put some extra like here we put percentages for the costs, percentage of net sales or income. But let's look at it in the program. It's clearer there. So I took input, income statement. So the working order is slightly different when you make the valuation. You don't go to normal order. You have to start with inputting these historical numbers. And typically they are entered. It's not that many numbers, but they can also be imported to an extra sheet and linked. And we also have a mapping tool that can be used. Okay, so here, in this case, this is the outcome of the sales for different geographical areas and different business areas. It's a growing business. And then we have the outcome for the costs, a really harsh level. And then added this formula to calculate the cost as a percentage of net sales or turnover. Like here, this is normally called income, but as always in Investor Excel, you can name any row, rename any row to your liking. You go top left, a small button below income statement heading, or on every page there's the same button. The first tab shows you can hide and unhide rows. The second tab is renaming. So here we have renamed income to turnover, or we can call it net sales, whatever, like this, and in different languages. And then it's renamed. So basically then we now focus on the historical periods. We enter the numbers, depreciations are entered, not calculated. And then here is entered also financial income and expenses. For historical numbers, it's of course relevant to get the correct net income. For the forward-looking statements, it's not that important because the valuation does not take into account the financing items anyway. So we have here the net income of the historical years. And then we jump directly to balance sheet. Next step. Let's go here also forward. So in order to make the valuation, we need at minimum one opening balance, one historical period. Here we have 4. And we enter the book values and other balance sheet items. But when it comes to book values, we also need to take into consideration how the book values will be, the assets will be depreciated from this point forward. And so straight line doesn't really work so good because if you think that you have, like, we take the machinery and equipment as an example, we have many different machinery and equipment, and they have been purchased in different occasions, and they are in different stage of the depreciation plan. So they will be ending the planned depreciation in different moments. So it will not be a even depreciation all ending at the same time to 0. It will be a falling depreciation. So one way is to compromise and just simply use declining balance, maybe slightly higher percentage, and then you will have a similar looking falling depreciation. But the best choice is of course if you have the depreciation plan, access to depreciation plan from accounting for an ERP, so that you can enter or link or copy the numbers here. You choose enter and it will remove the calculation and protection and give you a possibility to enter the values. And in practice in the program, first of all, you have a button here, top left under the heading balance sheet, to right of the hiding and renaming button. There is another gray button. If you press that one, it will open for input. It will open all rows for input. Basically, it's the same also if you choose level file here in this outlining, then you will also have all rows visible. And then you enter the book values and choose depreciation method. Immaterial rights, you can also just simply hide the ones that you didn't have. And continue with machine and equipment. And here is an entered depreciation plan. We choose enter and then copied or linked the numbers here. Buildings and structure, land and water not depreciated. Prepayments, constructions in progress. Also, these items can be renamed so that they suit you better. Other intangible assets. Let's make that falling also. And investments, deferred taxes, long term. Another investment not depreciated. Then if you go forward, we have the current assets. We have inventories, accounts receivable, other receivables, and bank and cash. And it goes without saying that, for instance, this other receivables, it consists of many accounts. So you might have to sum up because we don't have so many accounts in this balance sheet. It's limited number of rows. So that builds up the assets total, and then we go to the equity and liabilities. So we enter share capital and retained earnings, and then the profit and loss would come automatically from income statements. That's why income statement has to be modeled correctly. And we have then appropriations, provisions, minority interest, and then we have the long-term liabilities, interest-bearing and interest-free long-term liabilities, short-term borrowings, interest-bearing short-term and interest-free short-term liabilities. We have the accounts payable and other interest-free short-term debt. And again, this is typically you have to add it from several items. But that's it. So it's not so many numbers to input. And they can be imported also. Let's see. Okay, we were ready with that. And next phase is then to start making financial projections, looking at the forward-looking statements. And well, I usually do it in the order that they are located in the calculations tab on Invest for Excel workbook. So starting with CAPEX, then looking at profit and loss statement, working capital statement, cash flow statement, and balance sheet. So the first would then be the investments, the CAPEX. And the default is to include the maintaining investments, the replacement investment, maintenance investments, to continue the business as planned. And of course, if you now forecast the growth in sales, you would also need to have a growth in investments. And of course, it would be good to put them in according to different asset types with different depreciation terms. Now this is simplified. It's all in one. On one row, annual CAPEX, 5-year depreciation, so it's about growing. And to remember is that the first row in this acquisition template is sort of reserved for the price paid for shares. And it's like it's the buying part that makes that investment, not this company that we're evaluating. So, okay, let's look at it also in practice. I jump to input investment. And we now focus on this upper part, which is like the normal investment table. The only difference is that the first one is marked as main investment, and it's if I open, it says it's corporate acquisition actually. So that's reserved for the price of shares. Then the other rows are reserved for normal CAPEX and the depreciations. Then below we will have some other rows. We have the group investments and the goodwill calculation and allocation of overvalue or depreciation of goodwill or acquisition financing, that sort of things. But we come back to that later. Now in the valuation we only focus on the investments. And okay, one idea is also to compare to depreciations on annual level. I mean, if you invest less depreciation, then your assets become old and used. So 100,000 investments, and what do we have depreciations in the income statement for this year? Went too far already. Well, around 100,000, yeah. In historical periods, a little bit more. Okay. We have a little fall in depreciations. We should have a higher depreciation percent in this declining balance to have a systematically continuing flow of depreciations. Okay, but that's some details. But okay, we settle for 100 euros and 5% growth, because we had a 5% growth also in sales. Well, not really. Okay, but we're investing a little bit more. That was investment table, CAPEX plan. I go forward to next screen, which is forward-looking income statement. And we start the modeling with sales. So we look at different business areas and how they will develop over time according to our beliefs. And then the easy way is to put the cost as in relation to sales, so that maybe start with the percentage of turnover on net sales. So then taxes and depreciations, and we don't really need to model financing in this stage. Okay, let's look at it in practice. So we have some historical sales development here, which you can base the forecast on, and now you just choose one of the last year's sales and push this copy distribute button and choose a growth for it, and then you distribute. Of course, you can also have different growths for different periods, but I run it all with the same now. So, and you can see which growth numbers were used here, and they are all dynamic. So if I change here, it will impact on the whole row. So now it's 4% growth. And yeah, then as we put in the historical periods, the percentage of the cost item in relation to net sales, then we have these percentages. We can calculate an average or based on best knowledge, set a percentage for for the cost for the future. So here it's selected 86%. And this has been like the input value that has been distributed. And then the raw materials and consumables were calculated 86% out of net sales. And same way with external charges 1.1% and staff costs 6.8% and other variable costs 3.1%. This is one way to model. Of course, there is 1,000 ways to do it. And also when we make the forecast, we would also have to think about the impacts of the acquisition of the merger, so that there might be some economics of scale or synergies to take into account. So we would have to model those here in the income statement. Of course, they can be specified separately and then just included in the numbers here. And although we have a certain structure here for historical periods, we can adjust the structure for coming years freely. I can just add sub rows and sub levels and model any way I like. Yeah, the depreciation had a dip here, but we don't worry about that now. And here is some numbers for financing, but this is not needed for the valuation. This is something that takes a lot of time to model the debt and equity plans. So it's something you do later when really going for the acquisition. Then we have taxes and the net income. So you see, it's sort of realistic. Based on history, it looks good to the future also. Then we can actually go forward. The next is the working capital. What does the PowerPoint say about that? Well, basically it's just that it's really simple, because you see the historical term of payments for accounts receivable. You see the turnover period for inventories historically, and you see the average term of payments for accounts payable historically. So it's really easy to. So like for accounts receivable, as we had this downward trend, but we are thinking that minimum 7 days. So we use 1 week here for term of payment. So we enter 7 and distribute 7, and then it always calculates 7 days of sales to account receivable automatically. We have some other receivables, and here show the changes, but it's fluctuating and not so relevant. So we didn't plan here for any changes, so it will basically stay the same in the balance sheet without any changes. For inventories, okay, we see that there has been a long turnover period before, but it's gone shorter and shorter, and we assume that we are more efficient, and we plan for a 30-day turnover for inventories. So it calculates automatically again the value of inventories. Then accounts payable, same thing. We have the average term of payment, and we take a compromise 30 days here, and it will be calculated based on those 30 days. Excuse me. And then there are still the changes in other current liabilities, increase and decrease. So again, it varies, and it's not so systematic. So and it's not relevant. So we keep it on the same level, no changes. And the working capital is lower, much lower than before. So we sort of more efficient regarding the working capital here. We plan to be more efficient than it historically has been. Next page is then cash flow statement. I think now we can hide the historical periods and focus on the future. It's just an overview. We have the income and the costs, we have the taxes paid, we have the change in working capital, together they make cash flow from operations plus investments, and we have then the free cash flow. And this is the important row. The valuation will basically be done based on these values. Of course, each cash flow will be discounted to the beginning, and the discounted values will be added together here in the cumulative discounted free cash flow. And then the financial expenses come here down, and the tax effect comes here below. So they are not impacting the free cash flow. They do not impact the value of the company. And here we see the cumulative total cash flow. So, okay, we didn't model amortizations of debt or anything special. So it will accumulate cash here on the bank account over the years. So the next page is then the balance sheet. Let's now close it like that, so we get an overview. So basically, nothing special. All the items are maintained here automatically. The changes come from all the other screens, other pages. But if I go forward, I come to the key financials. And in this particular case, there were some manually made ratios, and then there were these that are included in the new 3.9 function. Let's you choose which is the first row, and from that row forward it will import the ratios. And these are of course important in evaluation of a business, because with this you can then assess the health of the company. You can compare to other similar companies. Also, if you know of some listed companies or transactions, so then you can compare ratios to set a correct valuation on this company. But here are the liquidity ratios, normal ones, some turnover ratios, some profitability ratios, business risk ratios, financial risk ratios, and stability ratios. And of course, these are all calculated per year. So it's always for a particular year, not for the whole term. And every ratio is explained with a written formula here to the left in D column. Just by hovering the cursor, you see how it's calculated. And anyway, just by clicking, you can basically, I need to, this button, by the way, is handy also. It removes the sort of ceiling, and you get to move freely. But then you need to put it back so that it works nicely, that you have the right commands for each page. So now if we go back to, I don't know, whatever it was, but let's look at this one. If I click it, it shows me that it's it's total current assets divided with short-term liabilities. Very simple formula. That is the current ratio. Okay. That's about the ratios, and then we will go forward to the main thing, the valuation of the company. Now let's have a look. I will make this slightly bigger. Yep. So the nominal value of all investments is every year, and is 1.258, discounted 877. The required rate of return on discounted is 7.3. The calculation term is 10 years, starting from beginning of 21, and that's also the calculation point. That's the point to where numbers are discounted. Then we have the present value of these operative cash flows during 10 years is 8,010,000. Then we have the present value of residual value, the terminal value, whatever happens after 10 years. And together, they added together to 15.8 million, and then we deduct the reinvestments, these investments during 10 years, their present value, and then we make some net debt adjustments to the value. We deduct the debt and add the liquid, the bank and cash, and then we get the free cash flow based equity value of the company, the value of the equity in the company. And we also have an indicator called equity value divided with EBITDA. But let's take one step backwards. I just wanted to give an overview, and then let's look at this in detail. First of all, where does this come? I mean, this we already modeled. So this is the present value of the operating cash flow for the first 10 years. I can, by the way, check if I look to cash flow statement. Okay. 7133. 801. Oh, yeah. I got confused by this media discounting. That's why it's higher, yeah. It would be the same otherwise. But then this one, yes. So notice that to the left there is a button for that row. And I press that button, it opens a yellow box for calculating the present value of the residual value, also called terminal value. So it now assumes going concern forever. And it bases the perpetual value on the last year's free cash flow, 10th year, 2030, with a free cash flow of 1.1 million, 1,151,000, without any growth or decrease forever. So 1.1 million divided with 7.3% discount rate gives a terminal value of 15.7 million. This 15.7 million corresponds to 9.63 times EBITDA of year 10 of year 2030. So this implied exit multiple divides this calculated resale value of the company in 2030 with the last year's EBITDA, and tells us that it takes like a little less than 10 years for EBITDA to cover this cost. So it gives an indicator on if it's expensive or not. You can compare to other transactions, similar businesses. And this value in 2030 should, of course, be discounted to the beginning of 2021 now when we make the valuation. So 15.7 million is 7.7 million in today's money. And that's the number we see here. Then, of course, maybe this is not a normal year. Maybe I want to base the extrapolation on some other year. Or maybe I want to make an adjustment. Maybe I want to take, if I had last year, but I want to base it on the 11th year, take it multiplied with 1.04, continue growth, 4% for the 11th year, and then base the valuation on that number. Here I can make whatever, I can enter a value or make a formula to calculate the base value for the perpetuity. Also, I can have some growth. Let's say it grows for 2% after that. Then, of course, it has an impact on the value. And don't be scared now. Now 730 changed to 530. It's just which number is used in the Gordon growth rate formula. It's still 7.30 required, but this 730 is reduced with this 2% growth. It can also be a decrease. If it is a business that will be decreasing, I can just put a minus change. And again, you see that it changed the other direction. Okay, that about that. So now I close it. And now we have adjusted, and now it's 14.3, and we deduct the investments, 13.5. And then next point with the button, interest-bearing net debt of acquired company. Let's open it, and we see that automatically it deducts the interest-bearing long-term debt in the opening balance. 1.3 million is deducted. It has to be repaid. Then it deducts the interest-bearing short-term liabilities, 108,000. And then it's also automatically adds the bank and cash. That's liquid money you can use immediately. You can also adjust these items. You can enter them manually if you like. Another manually enterable values are if you want to make manual adjustments. Maybe there is something else that it's not needed for the business. Maybe there's a yacht or something like that. You can sell immediately and earn something from that. Maybe you agree with the selling part that they will have some less dividend taken out. Maybe you also see a risk of some hidden liabilities that are not shown in the financial statements, and you want to take that into account. So, or it can be some positive also, of course. But anyway, so that's manual, and then after that correction, you then end to this equity value based on free cash flow, 14.2 million. So this is your forecast, and this is what you believe that it's worth. So this would be the maximum price you're willing to pay, and that would correspond to almost 17 years of last year's EBITDA. Again, a multiple that you can compare to other. But this is based on equity value, not enterprise value. Enterprise value is including debts. So this is the total present value is the same as enterprise value. Value, okay, whatever. But then when you adjust for debt, then you have the equity value. When you buy a company with debt and everything, then this is the transaction price. Okay, this was stage one valuation. Maybe we can make some sensitivity analysis. Actually, I planned for one here. Let's make it bigger. Just as an example. Now this net present value is now the enterprise value of the no, this is the equity value of the company. So we calculate the value 40.2 million using this discount rate 7.3. What if we would use a higher discount rate? What would we then be willing to pay? Let's put 8.5 and 10% and 7 and 6 and then press exclamation mark. So you see how the value of the company changes depending on what our required rate of return is, so our cost of capital has a huge impact on the value of the company. Yeah. Well, of course, here is 10 to 20 more other analyses to be done, but we are running out of time, so I will speed up to phase number 2. And okay, the presentation which you will be receiving had all these steps also explained, and step by step. And then phase 2, effects of the acquisition. Now, if we make an offer, put a price for the shares, so then we want to see how it will impact our business. How will it change our forward-looking financial statements? And how profitable is the acquisition as an investment? We can look at the normal indicators like net present value, IRR, and payback. And then, of course, it makes even more sense to make the sensitivity analysis when you have the investment cost burden included. Okay, and the first thing to do is to go to the investment table and put the price for the shares. And also we put the ownership share. And okay, anyway, let's go and do it. Input, investment. So the first row, what was it worth again? 14.2 million. Okay, let's assume we buy it for 11 million. Minus 1, like that. And it's of course not depreciated, it's shares. It's corporate acquisition. And now we can go look at the goodwill calculation. First of all, because this was a corporate acquisition, it was not this company that we have modeled that is making the investment. We are making the investment, the buying part. So it shows up in blue color. All the group items show up in blue color and in extra lines here below the normal rows. So here is the investment. And we put the price for the whole company. Now you can use this valuation for any share of buy, even if you buy a minority share like 20% or whatever, 10%. So you can also use, but you put the numbers for the full. You even for the price you pay for, let's say 10%, you assume the same price for all 100%, and then you make the calculation. To see the impact on income statement and balance sheet on group financial statements, it only works for majority ownership, like more than 50% upwards, so that it's like a subsidiary, but not for minority. This program does not support a minority impact. But of course, for valuation, you can take any share of the companies. That's not a problem. You will of course consider only your share of the net present value. Yes, so 100%. And then there is, here is the equity from the company we are buying, evaluating. And if we pay 11 million and the equity is 5,277, so there is an overvalue of 5.7 million that we are paying. And this overvalue should either be depreciated according to national GAAP, the old way to do it. So then if you don't use international accounting standards, US GAAP or IFRS, or if your national GAAP doesn't require it, and you choose to make a depreciation. Then you choose NGAP, and then you, on this row for depreciation, press this button and you enter the time for depreciation. Let's say depreciate over 10 years. Press OK, and you see you have the goodwill and how it's depreciated. However, if you follow international accounting standards, then the overvalue is never, the goodwill is never depreciated, it's always tested and then maybe written down. Or so, and also IFRS thinks that since we think that it's worth more, we also will be paying profit taxes, so there's the deferred tax liability automatically calculated from that value. And when it comes to IFRS, also the investors want to know, what are we paying for? Why do we pay that much too much? So we have to explain ourselves. Maybe, like I already selected here, maybe the building's market value is higher than the book value in this company's balance sheet. Let's say they make up to 1 million higher, and the buildings will be, this overvalue will be straight line depreciated over, well, let's put even, I don't know, let's put 10%, 10 years. And maybe there is some, you see some value which is not shown in balance sheet. Maybe there is some brand value, loyal customer base, or some royalty use rights, something that is not taken into account in the balance sheet. And maybe that's worth, let's say 500,000, and we will depreciate that over 5 years, so we put 20%, no, 10%, 10 years. And then maybe they have developed some new products, services, which, and the development cost has always been put as a cost into income statement, not activated to balance sheet. And we want to sort of take the value of that development, the new product, into balance sheet. So we let's put here 1.5 million and depreciate over 5 years. So now we have allocated 3 million, and maybe we cannot specify more than that. If we can specify more, we just press plus and get some more items to specify. Anyway, so then it will calculate again the deferred tax liability, corresponding deferred tax liability for each item. And the rest, which was not allocated, is the goodwill, 2.7 million. And these are all blue lines, so this is like group items. To see, in order to see the effects on group financial statements, we need to do these operations. And then we have the next point here, which is the financing of the corporate acquisition. So we have button. You can choose to enter a simplified. Let's say we put 7.5 million as debt, repayment 15 years, interest cost 5%, and then 3.5 million equity costs, 300,000. That's a lot. Or I can choose to use the financing module to calculate exactly the loan syndicate with all details, and then just press update here. But this is the simplified version. Okay, now we have also the financing. Oh, I'm running out of time. Now let's go fast forward. We go to income statement. This is the income statement of the subsidiary. And below the normal income statement, we have the blue lines. This is how the group financial statements will, the group income statement will change. So the income from subsidiary before appropriation taxes come here into the group financial statements and increases, and then we have the depreciations from the allocated values, we have the financing costs for the acquisition loans, and we have the tax effects, and then the group result effect. Negative in the beginning, but after a year, from year 6 forward, it's positive and growing, and some other ratios. Same way we have also in balance sheet blue lines which show the assets, how they change in the group financial statements, how the balance sheet grows, and on the other side then the long-term debt, short-term debt, tax liabilities, and equity correction. And now we have then a normal investment calculation. We had a present value, we have a investment, and we have a net present value, and we have a net present value as yearly annuity, we have an internal rate of return, we have a profitability index, and we have some other indicators. And we can continue with the sensitivity analysis, etc., to look at this investment profitability.